Welcome, dear traders. The closer the release of the US inflation data, the more restrained risk sentiment appears in the markets. After last Friday's better-than-expected employment report, the US economy may surprise once again. Given this unpredictability and the particular importance of price reports on the trajectory of interest rates, a wait-and-see stance on a forex looks quite logical. In addition, the comments from the Fed speakers received were rather hawkish. Raphael Bostic, president of the Atlanta Fed, believes that inflation has fallen more than initially thought. However, he sees a future decline of only 2/4 of a point and only by the end of the year. Michelle Bowman, the Fed's board member, said that inflation may fall further if the current settings remain stable. Against the background of restrained statements, the markets reduced their expectations of a more aggressive easing of the US regulator's rate, and this sentiment supported the growth of a US Treasury bond yields. In turn, US Treasuries acted as a tailwind for the US dollar. Yesterday, it received support from the Economic Optimism Index during the American session. This leading indicator measures the level of consumer confidence and optimism in the economic activity. The index rose to 44.7 in January, the highest level in the last 8 months. As a result, the US dollar tested the price area of 102.65. However, the optimism was enough only for this short-term surge. Today, the price of the US currency against its 6 counterparts began trading on a consolidation in a narrow flat of 102.45 and 102.65. Notably, the US dollar remains below its 3-week highs reached last Friday after the release of December non-farm payrolls. However, the currency shows no clear trend now. By the beginning of the European session, the greenback stabilized around the 102.50 mark. Most likely, we will not see a strong shift in the trading trajectory before the release of key data on the US inflation. However, we cannot rule out increased volatility and a move into a wider range between the 101.70 support and the resistance at 103 points. Yesterday's jump in the US dollar gave the Japanese pair a boost today. The pair continued its bullish trend, trading between 144.30 and 145.20 during the Asian session. The rise in the US Treasury yields is also putting pressure on the Japanese currency. The yen continues to lose ground for the second day in a row, and today the currency hit a new weekly low, breaking through the key psychological level of 145. Any further buying above this level will pave the way for the dollar-yen pair to continue rising towards the 146 level. On the other hand, the next key support level for the pair is at 144. However, the fundamental backdrop now supports the prospects for further yen depreciation. The fact is that today's Japanese average wage data showed a year-over-year decline. Nominal wages edged up a modest 2% year-over-year in November. However, this was not only the slowest pace of growth in nearly 2 years, it was also well below the 1.5% pace of the previous months, and the data pushed back to the potential timing of a hawkish policy shift by the Bank of Japan and left the yen unsupported. Notably, the Japanese regulator considers sustainable wage growth in the country as the main condition for abandoning its negative rates. The greatest hopes in this regard are now pinned on the so-called shunto. This is the negotiation season for collective wage hikes. The shunto is expected to culminate in March. In Japan's largest labor union, REGULATOR, intends to push for at least a 5% wage increase. In contrast to Japan, Australian economic data released this week offered a more rosy picture. Consumer prices fell slightly while retail sales and building permits surged. Given the resilience of the country's economy, the Reserve Bank of Australia may move to a softer stance. In turn, this should have put pressure on the country's currency. However, the Aussie is growing today on the daily chart in the range of 0.6680 and 0.6710. The main driver has been the sharp rise in oil prices. For example, Brent crude jumped to $78 per barrel on a Wednesday morning. The Australian dollar moved away from its 4-week lows and broke through the key psychological level of 0.67. The next technical support and resistance levels for the Aussie are at 0.6670 and 0.6870 respectively. After correction, the Kiwi currency pair also tried to maintain growth in the Asian session today. The pair maintained bullish momentum within their boundaries of 0.6230 and 0.6250. If the upside scenario continues, the Kiwi may test the resistance at 0.6290 or even 0.6360. In the case of a pullback, the pair may find the technical support at 0.6220. That's all for now. Stay tuned for more updates with the InstaForex TV. We appreciate your feedback. Please leave your questions and comments below and see you next time.